This video covers Ryohin Keikaku's third quarter financial results for fiscal year 2025 for the period from September 2024 to May 2025. Ryohin Keikaku is the Japanese company that owns and operates Muji, a global retail brand known for its minimalist, no-brand products. Ryohin Keikaku designs, manufactures, and sells a wide range of household goods, clothing, and food items, focusing on simplicity, functionality, and sustainability. Ryohin Keikaku operates Muji stores worldwide. Financial highlights for fiscal year 2025 third quarter. For the third quarter, Ryohin Keikaku's performance was better than expected, recording its highest ever profits and prompting an upward revision of the full-year forecast. In Japan, sales were strong during Muji Week in March and continued to perform well in April, leading to an increase in customer numbers. In mainland China, sales were strong during shopping season, and the company accelerated its store scrap and build strategy. In Southeast Asia, stayed at the same level, with performance varying by country. In Europe and North America, like-for-like sales remained strong, and profits improved due to the closure of unprofitable stores. Ryohin Keikaku also made steady progress in reducing product costs through supply chain sustainability reforms. Additionally, fluctuations in foreign exchange rates resulted in an operating gross profit margin that was higher than expected, while some IT costs in the global selling and administrative budget were not used. Consolidated financial results for the first 9 months. Ryohin Keikaku achieved significant increases in both revenue and profit, marking record highs that exceeded expectations. Operating revenue rose by 19.2% year-on-year to 591 billion yen, driven by strong like-for-like sales and an increase in the number of stores in Japan and overseas. Gross profit margin improved by 0.8 percentage points to 51.2%. Reflecting better product cost management, favorable foreign exchange impacts, and reduced discount rates in overseas businesses. Operating profit also increased by 39.9% year-on-year to 59.4 billion yen, as the SG&A ratio declined due to sales growth, resulting in an operating profit margin of 10.1%. Net income reached 43.5 billion yen. Increased by 30.1%, which included approximately 3 billion yen in tax benefits from the reorganization of its European business in fiscal year 2024. Segment results for the first 9 months of fiscal year 2025. In Japan, Ryohin Keikaku saw significant increases in both revenue and profit, with strong sales during Muji Week, and continued double-digit growth in like-for-like and e-commerce sales, particularly in frequently purchased categories like health and beauty, housewares, and food. In East Asia, revenue and profit also grew, mainly driven by strong sales in mainland China during promotions such as Labor Day and the 6/18 shopping season, and profitability improved due to reduced discounts and favorable foreign exchange impacts. In Southeast Asia and Oceania, both revenue and profit increased overall, supported by new store openings and foreign exchange gains, although local currency profits remained flat due to increased costs from store openings and hiring. In Europe and North America, revenue and profit rose as well, with profitability improving following structural reforms in Europe and store closures in Canada, alongside double-digit growth in like-for-like and e-commerce sales. Overall, Ryohin Keikaku experienced growth across all major regions, driven by higher sales, cost improvements, and strategic restructuring actions. FY2025 full-year financial results outlook. For fiscal year 2025, Ryohin Keikaku revised its outlook upwards for both revenue and profit compared to the previous forecast in April. They expect sales to increase, supported by strong performance in Japan and East Asia. Operating profit is also projected to grow, reflecting solid third-quarter results, improved profit margins due to favorable foreign exchange effects, and a lower cost ratio as sales expand. However, net income will include losses related to store impairments and other anticipated costs in the fourth quarter. Additionally, fourth quarter operating profit is expected to decline year on year due to the absence of foreign exchange gains recorded in the previous year and higher operating expenses. As a result, for fiscal year 2025, full-year net income is expected to reach a record high of 47 billion yen, representing a 13.1% increase compared to the previous year. Stock split. Ryohin Keikaku announced a stock split for the first time in 6 years since 2019. They plan to conduct a 2-for-1 stock split in the Tokyo stock market to reduce the investment amount per trading unit, aiming to make its shares more accessible to investors, especially individual investors, and to enhance liquidity and broaden its investor base. The Japan Resident Shareholder Benefit Program will remain the same after the stock split, with holders of 100 or more shares still receiving a 7% discount card. The record date for the stock split is August 31st, 2025, and it will take effect on September 1st, 2025. Stock price. This is the Japanese yen base chart for the last 1 year. The Japanese yen stock price is 6,979 yen as of July 11th, and the US dollar stock price is $48.61 as of July 11th. The stock price has been rising steadily. The current PBR is 5.83, and the PER is 39.4, with a dividend yield of 0.63%. Compared to the past few years, the PBR, PER, and dividend yield suggest that the current stock price is relatively high. The market has high expectations, which has pushed the stock price to a very high level. This level could be justified if the company continues to deliver double-digit growth as it has recently. Conclusion. Ryohin Keikaku delivered strong third-quarter results with record-high profits, driven by solid sales in Japan and East Asia, and improved cost management. Performance was robust across all major regions, supported by strategic restructuring and favorable foreign exchange impacts. For the full year, Ryohin Keikaku expects its net income to reach a record high again. Their strong performance is expected to continue,